Hello and welcome to the Brooks Macdonald podcast. My name is Richard Larner. I'm one of the co-chief investment officers here at Brooks Macdonald, and I'm joined by my co-chief investment officer, Michael Toolan.
Hello.
And head of fixed income and the co-manager of our Cornelian Risk Managed Funds, David Appleton.
Hello.
Thanks very much for joining me. We're going to talk about the gilt market, so UK government bonds today, and touch on a little bit of the recent history of how the fixed income markets evolved and become more attractive, and cover off as well a little bit basics about how the bonds are working in terms of that dynamic between the yield and the price. David, you can tell us a bit about the opportunity set that we see within Brooks and how we're using it in terms of portfolio construction and actual specific services that we offer. So over to you, please, Mike.
Sure, absolutely. We're at quite an interesting moment, largely in a fairly normalized interest rate environment, largely because where we've been. Pre-financial crisis in 2008, interest rates were around 5%. Then, of course, 2008 to early 2009, we have the global financial crisis and interest rates are slashed around the world. And here in the UK, base rates went down to 0.5%. At the time, the feeling was this was an emergency environment and wouldn't last particularly long. As it turned out, rates stayed very low for about 13 years. What that meant was the government, the Debt Management Office, are issuing bonds at that time with very low rates of interest, or in effect, very low coupons. Subsequently, following the inflation shock in 2022, interest rates have normalized, rising to 5.25% in 2023, and they are 4.5% today. So we're back to what we would describe as a more normalized interest rate environment. What's interesting, though, is with bonds in issuance pre-GFC, with what we would talk of as more normal sort of coupons, and those bonds that were issued in the 13 years at ultra-low rates, we've got an interesting opportunity set. And some of this is down to the nature of how government bonds work. Government bonds or gilts, and they're called gilts because traditionally UK government bonds were gilt-edged certificates, have two principal parts. And forgive me if I'm in a very sort of basic description, but I think it's important for some who may not fully understand this. The two parts are made up of, in effect, the principal. Now, the principal is the capital, the loan you are giving the government, £100 nominal, that is promised to be paid at a set date in the future. That £100 comes back to whoever has provided that loan, whoever owns that gilt on that date. And that is guaranteed. It is as secure a loan as you can get in the UK. It's issued by the government, and effectively the default risk is considered zero. Alongside that, there is the coupon. The coupons effectively are the rate of interest that is paid. These are predetermined when the bond is issued. They are fixed. They are paid semi-annually. And as I say, because we had this period of ultra-low rates, the government issued a number of bonds with coupons as low as 0.1%. But being fixed, we know exactly what that payment will be, when it will be received semi-annually, what the figure will be. The interesting part comes when interest rates change. So if the final repayment is fixed and the coupon is fixed, how do interest rates affect gilts, and how do they move the market? Now, of course, the one thing that isn't fixed is the price on a day-to-day basis. The redemption price is fixed, but the daily price isn't. And because we've had these rate moves, it's presented something of a really interesting opportunity for investors. And that is principally because the UK government bonds are not liable to capital gains tax on the principal. The coupon, the interest you receive, is liable to income tax at your marginal rate, but the capital return is tax-free. So I'll just pass over to David now, who'll sort of explain how that presents an opportunity for investors.
It's really about gilts as an alternative to placing money on deposit with banks, and where the rate of interest, the effective rate of return, is materially higher because of that tax efficiency. If you're able to buy very low coupon gilts at a discount to par, the majority of the return is coming through tax-free capital gains if you're able to buy and hold to maturity. So the opportunity that we saw was to develop an opportunity set, a portfolio service for our clients investing solely in gilts, but where we can put together portfolios of gilts that match the precise requirements of clients. It might be that they've got a particular cash flow requirement in a year's time, in 18 months, in 2 years. We can put together portfolios of gilts that can closely match those liability requirements, but generate a very attractive return. So just to put some numbers on it and give you some color, let's take the 3-year maturity point. So let's say you were happy to put your money away for 3 years. There's a bond that matures in 31st of January 2028, so slightly less than 3 years, with a 0.125% coupon. So a very low interest payment. The coupon is very low. But today you can buy that bond for £90, which means that you buy it today for 90 and you get £100 back at maturity on the 31st of January 2028. And because of that tax efficiency, it means the equivalent rate of return of that bond is almost 7% for a top rate taxpayer. So the measure of return that we look at is what we call the taxable equivalent yield, which is effectively thinking about what would the rate of interest you would need to get in a cash deposit be for the return to be the same as that gilt when you take account of the relative tax efficiency. So that particular bond has got a yield of 6.95%. That compares with the 3-year expected interest rate in the market of under 4%. So the yield to maturity of that bond is 3.89, which is effectively an expression of where interest rates will be on average over the next 3 years. So that's materially higher than current base rates, which is 4.5%, and materially higher than the average of what the market expects interest rates to be over the next 3 years. So that's a material advantage, and it's and from a risk perspective, if you're able to buy and hold to maturity, there is no risk. That return is guaranteed unless the government defaults, which is not a central scenario for us today. We think this is a really, really interesting opportunity set for the point that Mike made, which is that because the government issued so many gilts with low coupons during the 13 years of low interest rates, there's a very rich opportunity set in terms of lots of different gilt issues across lots of different maturity profiles that creates a really kind of healthy opportunity set for us, which we think will endure for a number of years. And it means that we can tailor portfolios to meet the precise requirements of clients.
And that's an interesting point, David, because not only do we offer the gilts service as a special service in terms of that sort of cash flow management in terms of for investors, but they actually now play a bigger part in our overall portfolio construction, particularly in more defensive strategies. That yield is quite attractive, and it is, as you say, lower risk. It's not without full risk, but it is lower risk, and it's better return than we're getting in the bank accounts at the moment. So
you're absolutely right, Richard. Yeah, absolutely. I would, 2022 was a transformational year for it's completely changed the risk-adjusted returns on offer from fixed income.
Yeah.
If you think about trying to beat inflation, the cash is now at 4.5%. Gilt yields are at between 4 and 5. The central bank is targeting inflation of 2%. So it's a positive real yield based on the target for inflation, and we think that is attractive. So you're absolutely right. And of course, with our private client portfolios, we try to also use that tax efficiency. So we will absolutely try and make sure that our clients' taxable accounts are where we hold gilts, and we'll favor those low coupon gilts to maximize that tax advantage. So it's not just something for the gilt portfolio service. We're absolutely taking that into account in terms of how we structure our portfolios across our client base.
Yeah.
Yeah, absolutely. I was just going to emphasize that key point because if thinking about gilts as cash equivalents, the critical point is expecting to hold those gilts to maturity. The guarantee is on maturity. The price can fluctuate between present and that redemption level. So targeting how long you're looking to potentially tie that money up for is critical to knowing with certainty what it's worth. And just one other point for using a gilt strategy instead of potentially a cash management strategy or tying up money on fixed terms with a bank. Clients are always, for example, considering and thinking about the £85,000 guarantee that each banking license has. Well, effectively with gilts, you're going straight to the guarantor behind that. So there's no need to concern about spreading it across different banks or so on. It is the underlying guarantor behind it who is effectively providing the caps.
And even though these are, invested over a certain time frame, I think investors should be, made aware that these are not a fixed term deposit. You are not locked into this. There is a secondary market. You can trade these between now and maturity as well. It's not
Exactly. And the example David used of the January 28 gilt maturing at 100 and currently at 90. We do know that the direction of that journey. That's not to say that it couldn't go to 89.95 next month, but we know it goes from 90 to 100 over the just under 3 years that it exists. So we've got good vision and clarity of where it's going. And as David described, the closer we get to that repayment date, the greater the certainty of exactly what that number is. And of course, ultimately, the government will cover and repay these debts by issuing new ones in the future. That's how interest rate markets work.
So, David, just in terms of, you mentioned that the risk of the government defaulting, which is, in I guess in most investors' eyes, pretty low chance of that happening. Are there other risks within fixed income markets and bonds, the gilts particularly?
Yeah, I mean, I think, yeah. So, I mean, clearly at the moment, the big driver is certainly if you're owning short-dated gilts, the big driver of pricing is expectations of interest rates, which in turn are really driven by inflation, and that's clearly at the moment a little bit uncertain. We know that inflation is highly likely to increase this year because of the mandated price increases that are likely to come through because of the policy changes in terms of the labor cost increases that are coming through taxation. But thereafter, it's a bit more difficult to predict. And equally, if companies are holding back on hiring, etc., it's likely that inflationary pressures could actually ease and undershoot in the following year. So kind of that is definitely the main driver at the moment at the front end, which is 0 to 5 years, which is where we're typically focused. That's definitely where what drives pricing there. Longer term gilts are influenced. The pricing is driven by lots of different factors. So what we've seen, which is quite interesting, is a steepening of the yield curve. And by that, I mean that longer dated gilts, 10, 20, 30 years, are now offering a higher rate of return than shorter dated gilts. And that's what we call the term premium. And that's actually a very healthy position. But I think it just generally reflects that markets are very cognizant that governments across the world have their indebtedness has gone up. And it's increasingly difficult to balance budgets, to raise taxes, and to get strong economic growth. So I think that's just generally a feature of most developed market government bonds, and you do get correlations between them. So what happens in America in particular, if US Treasury yields at the long end go up, that tends to also have a spillover into our market. So there's at the longer term end of the gilt market, there's a lot of factors, global macroeconomics that can influence it. But at the short end, when you're buying and holding to maturity, it's really shorter term interest rates, which is controlled by the Bank of England, that's driving the pricing. And there, we just had the Bank of England keep rates on hold at 4.5%, but also signal that their central expectations is that interest rates are likely to ease gradually in the coming years. So I think the gilt pricing is very much in line with that current guidance from the Bank of England. And of course, there's two-way risks to that. Interest rates could fall quicker if we get a more recessionary environment. Equally, rates might need to be kept in line with where they are currently if inflationary pressures prove persistent. So as ever, there's a few things going on there. But if you're buying and holding to maturity, all of that volatility that may come through isn't actually, it doesn't matter so much because you're locking into that return.
Another point that clients sometimes ask about is what's the risk of changing the tax status and making those gains liable to capital gains tax? And my answer to that is it can't be ruled out, but for the government to make the gains on gilts liable to capital gains tax, they would also have to make the losses on gilts offsettable against capital gains tax. And the fact that, for going back to the gilt we've talked about, the January 28 gilt is trading at 90. That was issued at 100. So everyone who's owned it from issuance has got a loss on it. So they potentially could sell it and realize a loss to offset gains elsewhere. So I think that's probably a zero-sum game, probably doesn't really make the government any money. And I just think it a low probability that the government could change. So I don't see that as a very real risk. If it was to change, all it would mean is your return to maturity would still be exactly what it is, i.e. the 90 goes to 100 and you get these coupons along the way, but the tax equivalent status for a 45% taxpayer is no longer nearly 7%. It's just much closer to 4%. So you're still guaranteed with what your money in your pocket is. It's just the tax paid on it.
Okay, good. So thanks very much, Mike and David. Just very briefly then, quick recap from your key point you want the listeners to take away?
Yeah, I would just say that it is a genuinely exciting opportunity to be able to earn high single-digit returns from lending to the UK government. That has not been an opportunity for a long, long time, and it's here today, and I think it's very exciting.
Yeah, I think in addition to the tax efficiency of these low coupon bonds, the thing that's absolutely striking is the security. These are the lowest risk loans you can make effectively, rather than cash in the bank, if you are lending to the guarantor behind the bank. So not only are they tax efficient, they are completely secure, held to maturity.
Yeah, important point. Okay, thank you very much for listening, everybody. Again, if you need to find out any more information around Brooks Macdonald's investment services, or particularly the Gilt Portfolio Service, please get in touch with your Brooks Macdonald representative or have a look at brooksmacdonald.com. Thank you very much.